Hey everyone, welcome back. Today we're diving into a really cool paper
Oh, yeah.
about institutional investors and, all that carbon emission stuff. So get this, the paper's called,
Okay.
Do All Institutional Investors Care About Corporate Carbon Emissions? Catchy, right?
It definitely grabs your attention.
It does. It's from Energy Economics, published back in
Yeah.
2022.
Yeah,
And it's got some pretty interesting insights.
for sure.
Like, we're going to see how those investors with like a really short-term
Interesting.
outlook, the ones who are just thinking about the next quarter, might actually
Yeah.
end up giving a company's value a boost,
Huh.
even if that means like higher carbon emissions.
Wow, that's counterintuitive.
I know. It's like, what?
Totally.
And there's this great quote in the paper from John Doerr.
Oh,
I
yeah.
don't know if you're familiar with him.
Venture capitalist, right?
Yeah, exactly.
Yeah.
Big name in venture capital.
Mm-hmm.
He basically says, if we don't like seriously shift to a low carbon economy, like right now, this decade.
This decade.
Yeah, he's not messing around.
No.
He says it's going to be bad, not just for the planet,
Right.
which we all know,
Of course.
but for the U.S. economy too.
Interesting.
Big time.
Wow.
And then they also quote Ignacio Escalon,
Iberdrola.
ding, 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 the CEO over there.
Yeah.
He's all about how companies need to like get with the program,
Yeah.
adapt to this whole changing climate thing,
Right.
and actually look for opportunities in a clean economy.
Yeah. Makes sense.
So it's like everyone's starting to see
It seems like it.
this connection between the climate
Yeah.
and,
Yeah.
the economy.
It's all connected.
Totally. Okay, so before we get too deep into this, maybe we can just
Yeah. Good idea.
level set a little bit. So for folks who aren't like
Sure.
finance gurus,
Mm-hmm.
what exactly are institutional investors?
Okay, so think of them as the heavy hitters in the investment world. Like, these are not your everyday investors. We're talking about big organizations.
From big leagues.
Yeah, exactly. Like pension funds would be one example.
Okay,
Then you've got investment companies, insurance companies, that sort of thing.
got it.
And they handle these huge portfolios of assets, for their clients. And because they own so much stock, they've got this power, right?
Oh, yeah.
To actually influence how companies do business.
So this paper's looking at whether that power, extends to a company's carbon footprint.
Exactly.
What did they find? Like, big picture.
Okay, so they took a look at data
Okay.
from over 2,000 U.S. firms, and this was between 2007 and 2017.
Okay.
And basically, they found this general trend that the more institutional ownership a company had,
Mhm.
the lower their carbon emissions tended to be.
Interesting.
Yeah, but hold on, there's a twist.
I knew there had to be a twist.
There always is, right?
Yeah.
So it turns out it's not as simple as that,
Okay, I'm all ears.
because they dug a little deeper.
Love the details.
Right. And they found that some types of institutional investors, well, they have a much bigger impact
Oh, really?
on those emissions than others.
So it's not just like a blanket statement.
No, not at all. That's what makes this deep dive so interesting, right?
Yeah, totally.
Yeah.
Like the nuances are where it's at.
Exactly.
So let's break down these different types of investors then. The paper,
Okay.
I guess, pretty specific
Yeah.
in the categories.
It does. So one of the first distinctions they make is between independent investors
Independent investors, okay.
and gray investors. And independent investors, they tend to be
All right.
more hands-on,
Oh, interesting.
more involved in what's called corporate governance.
Okay.
So they're the ones who are more likely to actually go talk to the company's management
Mm-hmm.
and push for some changes.
Got it.
And in this group, you've got your investment companies, investment advisors,
Okay.
and pension funds usually.
Okay, so those are the independent investors. Now, what about these gray investors? What makes them different?
Well, gray investors, they're a little more passive.
Passive.
Yeah, they kind of take a back seat. You're talking about banks, insurance companies, that kind
yeah.
of thing. They're not typically as proactive, I guess.
So, did the study find that it's the independent investors who are really making a difference
They did.
when it comes to lowering those emissions?
Yeah, their influence was way more significant than the gray investors.
Interesting.
Which, thinking about it, it makes sense, right?
Yeah.
Because they're the ones who are actually rolling up their sleeves and...
Getting in there.
Exactly.
Okay, now, here's where I got a little tripped up reading this study.
Okay, I'm like...
They talk about, the difference between
Oh,
long-term and short-term advisors.
Yeah.
And I would have assumed that,
Mm-hmm.
the investors who were thinking long-term
Right, the ones with the longer view.
Yeah, they'd be more concerned about sustainability and all that.
Makes sense.
But the study found kind of the opposite, didn't it?
Yeah, it did. It's kind of counterintuitive.
Let's go on there.
Well, they found that companies with a higher percentage of those long-term investors actually had a bigger impact on reducing emissions.
Oh, really?
Yeah. Isn't that wild?
That is surprising. Like, what's the logic there?
Well, one theory is that maybe those long-term investors, they're more willing to accept some of those upfront costs that come with, reducing emissions.
Because they're in it for the long haul.
Exactly.
Yeah.
They're thinking about those long-term benefits.
Yeah, the long game.
Both for the planet and for the company's financial performance down the line.
They can see the big picture.
Yeah, exactly.
Okay, so we've got independent investors, we've got long-term investors.
Mm-hmm.
Both of those seem to be linked to,
lower emissions.
Lower emissions, yeah. Now, what about this third category?
Okay, which one?
The monitoring institutional investors.
Ah, yes. The monitoring investors.
What's special about them?
So these guys, they're the ones holding a huge chunk of a company's stock.
Okay, so they're really invested.
Yeah, literally. And that big ownership stake, well, it gives them more incentive, right?
Yeah.
To actually keep an eye on what the company's doing.
Makes sense.
And engage with the management to make sure things are,
running smoothly.
Yeah, running smoothly. And that includes their sustainability efforts, of course.
So they're not just sitting back and collecting dividends.
No, they're actively involved.
Okay, so the study found that these monitoring investors, they have the strongest influence on lowering emissions.
Out of all the categories, yeah.
Wow, so it really does matter. Like,
it really does.
What kind of investor company has.
Absolutely. But what's even cooler is this paper, it goes beyond just naming these different types of investors.
Okay.
It actually looks at how are they actually doing it?
Oh, I see. So what's the secret sauce?
Well, the study highlights two main mechanisms, right?
Two main mechanisms.
Okay. The first one's pretty straightforward. Direct impact on energy consumption.
Oh, that makes sense.
Right. So they found this really clear link between higher institutional ownership and the company using less energy.
Got it.
And less energy used means...
Fewer emissions.
Fewer emissions, exactly. Simple, but effective.
Okay, so that's mechanism number one. What's the second way they're influencing emissions?
All right, so the second one is all about what's called shareholder activism.
Shareholder activism, okay.
So institutional investors, they can actually use their position to advocate for more sustainable practices.
Oh, I see.
Right. They might vote against management proposals if they think they're bad for the environment.
Okay.
Or they might even propose their own ideas, like for stricter emissions targets.
Interesting.
Or investments in clean technology. So they're not just talking the talk, they're walking the walk.
Putting their money where their mouth is.
Exactly.
And did it actually find a link between
institutional ownership and these kinds of proposals?
Yeah, they found a positive correlation
between the level of ownership and the number of proposals focused on emissions.
Exactly.
Okay, so it sounds like investors are getting more and more...
Yeah, it seems like it.
...proactive about climate action, which is great.
For sure.
But here's the big question, right?
Hit me with it.
Do all these efforts to reduce emissions, do they actually lead to a higher firm value?
That's the question, isn't it? Does doing good for the planet
also mean doing good for the bottom line?
Exactly.
Well, the answer is, as always,
I'm sensing a but coming.
It's complicated.
Of course it is.
The study found that the impact of emissions on a company's value, it actually depends on which type of institutional investor we're talking about.
Oh, interesting. Okay, I'm ready for the breakdown.
All right, so let's start with those monitoring investors. Remember them?
The ones with the big ownership stakes.
Exactly. Big stakes, big influence. So they found that companies with high emissions,
but also high ownership by these monitoring investors, they actually saw their firm value go up.
Wait, really? So even though they're still polluting, the market's rewarding them?
It seems that way. It's like investors are saying, hey, we see you've got these engaged investors on board, so we're willing to bet on you even if your emissions aren't perfect yet.
Interesting. So they're looking at the potential for improvement.
Yeah, exactly. Now, get this. The opposite happened. For companies with high emissions and high ownership by long-term investors, those companies saw their value decrease.
Now, hold on a second.
Yeah.
Didn't we just say that both monitoring and long-term investors
I did, yeah.
are linked to lower emissions?
Yep.
So why are the long-term investors getting penalized here?
That's the million-dollar question. And the paper doesn't really give us a clear answer.
Oh, gosh.
I know, right? But they do offer one possible explanation, and it's that maybe
Okay, what is it?
investors are starting to expect faster action on this whole climate thing, even from those investors who are known for playing the long game.
So maybe patience is wearing thin.
Maybe so.
It's like people want to see results now.
Right. They're not willing to wait decades for things to change.
Yeah, which, I mean, I get it. The climate crisis is like...
It's urgent.
Yeah, it's not something we can just put off.
Exactly.
But it does make you wonder, like, what are those monitoring investors actually doing?
Yeah.
To drive those emissions down?
Right. Do they have some kind of playbook?
Yeah, like, what's their secret?
Well, that's the thing.
Okay.
The paper doesn't really get into those specifics.
Oh, come on.
I know. It's more about those big picture trends.
So we know they're having an impact.
Yeah.
But we don't know exactly how they're doing it.
It's like they gave us the map, but not the directions.
Exactly.
Yeah.
So frustrating.
Right. But hey, that just means we've got more questions to explore, right?
True.
Oh.
Always more to learn.
Like, what tactics are they using? Are they pushing companies to invest in, energy efficiency upgrades? Or maybe advocating for switching to renewables?
Oh, good points. And what about all that shareholder activism stuff?
Mm-hmm.
We know they're submitting proposals about carbon emissions.
Right.
But what are they actually asking for in those proposals?
Yeah, the paper doesn't really spell it out, does it?
Nope, just that they're becoming more common.
Which makes me think, wouldn't it be fascinating to actually analyze the content of those proposals?
Oh, for sure. Like, are they demanding more aggressive emissions targets?
Exactly. Or maybe calling for more investments in clean technology.
So many possibilities.
I know. This is what I love about these deep dives. It's like we start with one question, and it leads to a whole bunch of new ones.
Like a rabbit hole of knowledge.
Exactly.
Speaking of which, something else I thought was really interesting in this paper
Okay, what's that?
was they had these quotes from John Doerr
Oh, yeah.
and Ignacios Galan.
Those are
Right. And it really highlighted how this whole carbon emissions thing, it's not just an environmental issue anymore.
Oh, definitely not.
It's like a major economic issue, too.
Yeah, totally.
Like John Doerr, he basically said, if we don't get our act together this decade.
This decade.
Yeah, he was very clear about that.
He was.
There's going to have some serious economic consequences for the U.S.
Wow.
Yeah, not just environmental ones.
That's...
And then Ignacio Escalon, he was talking about the need for companies to adapt.
Yeah, adapt to the changing climate.
Exactly. And actually look for opportunities in,
the clean energy sector.
Yeah, like be proactive about it.
Like a whole new way of thinking.
Totally. So it's like investors are starting to realize that climate change is a financial risk.
For sure.
Just as much as it's an environmental one.
Mm-hmm. And that realization is driving a lot of the actions we're seeing, right?
Yeah, totally.
Yeah.
Which leads me to this really important question.
Okay.
So if these monitoring investors, they can somehow pull off this magic trick of reducing emissions and boosting a company's value.
Yeah.
What does that mean for us regular folks?
The individual investors.
Yeah, like you and me.
Right, the people who aren't managing millions of dollars.
Exactly. Does this research give us any clues about how to invest?
Well, I think it definitely highlights an opportunity.
Okay, I'm listening.
Like, if we can learn to spot these monitoring investors and figure out what they're doing, we might be able to use that knowledge to make smarter investment decisions.
Smarter in terms of?
Both our finances and the environment.
Oh, interesting. So it's not just about, divesting from fossil fuels or whatever.
It's more nuanced than that.
Yeah, it's about being more strategic.
Exactly. Understanding the different approaches that investors are taking.
So we need to do our research.
For sure. And support the companies that are really walking the walk when it comes to sustainability.
Okay, so we've talked a lot about investors.
We have.
But what about the government? Oh, interesting. Like, do you think there's a role for regulations here?
You mean to encourage investors to engage with these climate issues?
Yeah, exactly. Could regulations help accelerate this whole thing?
Well, the paper itself doesn't really focus on that.
Okay.
It's more about what investors are doing voluntarily. But I do think there's a lot of potential there.
For government policies to incentivize investors to take climate change more seriously.
Exactly. Like, imagine if there were regulations that required investors to disclose their carbon footprint.
Oh, that would be interesting.
Right. Or maybe even set targets for emissions reductions in their portfolios.
That'd be a game changer.
It would. And it would give individual investors,
like us.
yeah, much more transparency.
We'd know who's actually doing what.
Exactly. And it would put pressure on companies, too.
To clean up their act.
Yeah, knowing that their investors are being held accountable.
I like it. More accountability all around.
Right.
Huh. Okay, but we should also acknowledge, like...
That's that.
This study has some limitations.
Oh, for sure. Every study does.
True. Like, they only looked at U.S. firms.
Right. That's a good point.
So, do we know if these findings would hold true in other parts of the world?
Well, it's hard to say for sure.
Yeah.
Because different countries have different rules, different cultures, you know.
Right. So it's possible that the relationship between investors and emissions might look different in Europe or Asia.
Exactly. It would be fascinating to see more research done in other regions.
Totally agree.
Just to compare and contrast, see what's similar, what's different.
Yeah, get a more global perspective.
Exactly.
And another thing that stood out to me was that the companies were self-reporting their emissions data.
Ah, yes. The self-reporting issue.
Is that reliable? Like, couldn't companies just fudge the numbers?
Well, it's definitely a valid concern.
Yeah.
It highlights the need for more transparency and accountability.
Mm-hmm. We need to know that the data we're using to make decisions is actually accurate.
Absolutely. Luckily, there's some positive developments on that front.
Oh, like what?
Well, there's a growing movement to standardize and verify corporate sustainability data.
Oh, that's good to hear.
Yeah, it's a step in the right direction.
Definitely. And of course, we also have to remember...
What's that?
This research was published back in 2022.
Right, a few years ago.
So... who knows how much things have changed since then.
Yeah, the world of sustainable investing is constantly evolving.
So it's important to stay up to date.
Absolutely. Always keep learning.
Okay, so we've covered a lot of ground here.
We have.
We've seen that not all institutional investors are created equal.
Nope.
And we've uncovered a whole bunch of new questions.
We definitely have.
About how they operate and whether their actions actually translate into,
higher firm value.
Yeah, exactly. But there's one thing we haven't really talked about yet.
Okay, I'm intrigued. What is it?
Well, we focused a lot on how investors are trying to influence companies.
Right.
But what about the other side of that equation?
Oh, interesting. You mean, how are companies responding to this pressure?
Exactly. Because ultimately, real progress depends on companies actually being willing to change. Right.
Absolutely. It's a two-way street.
Yeah, it's a partnership.
So the question is, are companies stepping up? Are they setting more ambitious emissions targets? Are they investing in clean technologies?
Yeah. Are they fundamentally changing their business models to align with,
a low-carbon future?
Exactly. These are all critical questions.
They are, because sustainable investing isn't just about investors telling companies what to do.
Right. It's about working together.
Exactly. It's a collaboration.
To create a more sustainable future.
A future that works for everyone.
And that's a future I think we can all get behind.
I'm definitely on board.
It's pretty cool to think about, right? Like our choices actually can make a difference.
I know. And I think that's one of the most hopeful things about this whole research paper, It shows that we're not just stuck. Like there are things we can actually do.
Totally. We're not powerless. Well, looks like we've reached the end of our deep dive today.
Time flies when you're having fun.
It really does.
Yeah, hey.
And I don't know about you, but I'm feeling pretty energized by all this, Like learning about how investors are actually using their influence to push for change and stuff. It gives me hope.
Me too. There's definitely a lot of potential here. Like it seems like the financial world is finally waking up to this whole climate change thing.
Yeah, better late than never, right?
Exactly. And they're starting to realize that sustainability, it's not just some feel-good thing. It's actually a smart investment strategy.
Which is huge.
It is.
So to everyone listening out there, I want to say, keep learning, keep asking questions, and keep pushing for that sustainable future.
It's up to all of us.
Because every choice we make, whether it's how we invest or how we spend our money, it matters.
It all adds up.
So until next time, happy diving.